Wall Street slashes thousands, oversight gutted overnight.
Financial watchdogs axed, America faces blindfolded collapse.
2008 warning signs flash red, but nobody's watching.
Crisis brewing, jobs vanish, oversight dismantled, risk explodes.
Wall Street isn't just trimming fat, it's carving straight into the bone. 2,000 bankers are being cut loose. At the very same moment, Washington is axing 2,300 financial regulators, the very people who are supposed to guard against disaster. Think about that. The watchdogs are being fired at the exact same moment the wolves are stirring. The last time we saw layoffs this deep and oversight this weak was 2008, and we all remember how that ended. Trillions lost, millions of homes foreclosed, lives shattered. Now the warning lights are flashing again. But this time, the cuts are bigger, the safeguards thinner, and the global economy even more fragile. The question isn't if the system is breaking, it's whether anyone will notice before the crash hits ordinary Americans. Wall Street is in retreat. According to reports, Morgan Stanley alone is preparing to slash around 2,000 employees by the end of the first quarter of 2025. And these aren't just low-level clerical jobs. The cuts stretch across the front office, the back office, investment banking, wealth management, entire divisions of the financial engine. At the same time, the federal government is shrinking the very agencies designed to keep Wall Street honest. The Trump administration has announced plans to cut more than 2,300 jobs from financial regulators, a group that includes bank examiners, economists, and criminal investigators. In plain terms, the people who would normally check the books, catch the fraud, and blow the whistle are being taken off the field. So what do we have? A financial system bleeding talent, oversight collapsing, and a memory still raw from 2008 when exactly this combination, layoffs, deregulation, and blind faith in the market, ended in catastrophe.
Let's rewind. In the years leading up to 2008, banks loaded themselves with risk. Mortgage-backed securities, subprime loans, derivatives stacked like dynamite. On the surface, profits looked unstoppable. But underneath, regulators were thin, oversight was weak, and warnings were ignored. By the time the crash came, it was too late. Lehman Brothers collapsed. The Dow Jones lost nearly 7,000 points in just months. The unemployment rate doubled. Foreclosures ripped through American neighborhoods. Nearly 10 million families lost their homes. And here's the haunting part. Many of the same ingredients are on the table right now. Job cuts, oversight gutted, ordinary people dangerously exposed. Take this year alone. In the first 3 months of 2025, financial services firms across the US hired just 75 new employees. That's barely a flicker of growth, only slightly better than the 0 jobs added in the same period last year. Compare that to the tens of thousands hired annually in healthier years, and the slowdown looks chilling. Meanwhile, regulators are losing more than 2,300 positions. That's not just trimming, that's gutting. It means fewer examiners to inspect bank balance sheets, fewer investigators to track financial crimes, fewer economists to spot systemic risks before they detonate. Imagine flying a plane with half the mechanics laid off and half the air traffic controllers fired. That's what America's financial system looks like today. Some might say job cuts happen all the time. Regulators come and go. This is just business. But here's why that argument collapses.
First, the scale. 2,000 Wall Street jobs gone from just one bank. Multiply that across the sector, and you're staring at tens of thousands in limbo. Second, the timing. Job losses during a period of rising global instability, trade wars, inflationary pressures, interest rate whiplash don't happen in a vacuum. Third, the contradiction. At the very moment banks are laying off workers, regulators who should be tightening scrutiny are being dismantled. It's like firing security guards the same night burglars break in. Markets don't collapse all at once. They leak, creak, and wobble before they break. Right now, the early tremors are visible. Credit conditions are tightening, lending volumes are slowing. Banks are hoarding liquidity, keeping cash close instead of pushing it into the economy. These are the same warning signs we saw in 2007, just before the house of cards came down. And here's what makes it worse. Without regulators in place, those warning signs may never be acted upon. The next bubble, whether in corporate debt, housing, or new shadow banking structures, could inflate unchecked. This isn't just about America. Australia is already feeling the ripple. Reports show that in early 2025, Australian financial firms hired barely more than a handful of new staff. China is pushing offers to join hands in trade partnerships while Australia rejects them and sides with the US. What does that mean? It means America's financial fragility is colliding with geopolitical stress, trade wars, alliances, economic retaliation, a fragile system at home linked to a fragile order abroad. That's not stability, that's a recipe for contagion.
Here's the part that matters most. This isn't just a Wall Street story, it's a Main Street story. Because when jobs vanish and oversight collapses, the risk doesn't stop at the banks. It flows straight into people's lives. It means your mortgage could become harder to refinance, your retirement savings more vulnerable to market shocks, your job more exposed to the chain reaction of layoffs. Just as in 2008, ordinary Americans will carry the weight, while Wall Street and Washington point fingers. So here's the question. If the warning signs of 2008 are flashing red, why are we dismantling the very defenses that could protect us? And what happens if this spiral doesn't stop now, but accelerates? Now we'll dive deeper into the hidden incentives, the global shockwaves, and the possible scenarios waiting around the corner. We left off with the question that should keep every American awake at night. If the warning signs of 2008 are flashing red, why are we dismantling the defenses? The answer, as always, lies in incentives. Incentives built not for stability, not for safety, but for profit, politics, and short-term survival. Let's start with Wall Street. Why slash 2,000 jobs? Banks insist it's about efficiency, cutting costs in a tighter economy. But look closer. Investment banking revenues have slumped, global deal-making has cooled, rising interest rates have squeezed lending margins. To protect profits, Wall Street cuts workers. But there's another layer. Cutting staff signals to investors, we're lean, we're disciplined, we're protecting margins. It's less about survival, more about stock price theater.
Now shift to Washington. Why cut regulators at the exact moment oversight is most needed? Politics. Trump's administration frames it as draining the swamp, reducing bureaucracy, trimming costs. But what it really means is fewer watchdogs, weaker scrutiny, and more freedom for banks to take risks without interference. So, the incentives align. Banks chase profits, Washington cuts oversight, and the system grows fragile. The same formula that detonated in 2008. This spiral doesn't stop at America's borders. Consider Europe. The Eurozone is already struggling under sluggish growth, high debt, and fragile banks in countries like Italy and Spain. A financial shock from Wall Street could rip straight into Europe's exposed veins. Consider Asia. China is pushing hard to create its own financial alliances, offering deals to Australia, building its own payment systems, trying to erode US dominance of the dollar. If Wall Street falters, China gains leverage. The balance of power shifts. And consider emerging markets. When Wall Street sneezes, they catch pneumonia. Rising US interest rates already make it harder for developing countries to borrow. Add a US financial crisis, and capital will flee overnight. In other words, a Wall Street collapse is not just America's problem, it's a global contagion. So, what happens if the spiral continues unchecked? 3 scenarios stand out. Scenario 1, the controlled slowdown. Job cuts deepen, but regulators scramble to hold the line with limited staff. Markets wobble, but avoid outright collapse. Painful, but survivable. Scenario 2, the unseen bubble. With fewer watchdogs, hidden risks build up in corporate debt, real estate, or shadow banking. One expected shock, a geopolitical crisis, a trade war flare-up, triggers a sudden chain reaction. Markets plunge, banks scramble, ordinary Americans feel the shock in their savings and jobs.
Scenario 3, the 2008 replay. This is the nightmare. Job cuts drain Wall Street of capacity. Oversight collapses. Risk builds quietly, unseen. Then, one morning, a major bank fails. The dominoes fall, just as they did in 2008. Trillions wiped from global markets. Millions of jobs lost. A generation scarred. Some might say we've learned from 2008. We have safeguards, stress tests, Dodd-Frank reforms. True, on paper, but paper doesn't stop panic.
And when regulators themselves are slashed, even the best reforms become hollow. And here's the darker truth. The global system today is more fragile than in 2008. Debt levels are higher. U.S. federal debt is above $34 trillion. Geopolitical fractures are sharper. Trade wars, sanctions, alliances breaking, and public trust is thinner. Another bailout on the scale of 2008? Politically unthinkable. So this time, the safety net may not exist, and when the fall comes, it could be harder, faster, and deeper. Here's what makes this terrifying. Ordinary Americans don't see it coming. In 2007, people were told housing was safe, jobs were secure, retirement accounts were stable. Then the floor collapsed. Today, it's the same. The headlines say layoffs, budget cuts, regulatory streamlining. But behind those words are real risks, mortgages harder to refinance, 401ks vulnerable to sudden shocks, entire industries at risk of contraction. And yet most people won't realize the danger until it's already too late. 2008 taught us one brutal lesson. When oversight vanishes and greed runs unchecked, collapse is inevitable. But that lesson is being ignored. The same playbook is being repeated, and history doesn't forgive repetition.
The signs are here. Job losses, oversight gutted, global instability rising, and the voices of warning are drowned out by promises that everything is fine. So where does this leave us? America stands at the edge of a familiar cliff. The guardrails are gone, the storm clouds are gathering, and the people who should be sounding the alarm are being shown the door. The question isn't whether we can avoid risk. Risk is already here. The question is whether we recognize the warning signs in time, or whether, once again, we will only see the danger after the crash has already taken everything. Because when 2,000 bankers vanish, 2,300 watchdogs are cut, and the shadows of 2008 stretch across Wall Street again, the real danger is not that history might repeat itself. It's that this time, it could be worse.